Mitchell, thanks for joining me today on the show.
Thanks, Chris. Glad to be here.
Thanks for coming up to Fort Worth.
Yeah, it's exciting. One of my big clients is up here, so it's a good chance to get up.
Yeah, Mitchell and I met on Twitter 6 months ago, maybe a year ago. We become friends online, but we're actually meeting today in person for the first time. You actually met another friend from Twitter who's a client yesterday.
It's all Twitter, man.
It's insane. Let's just start with a little bit about kind of your story growing up and what you do today.
Sure. So yeah, I'm grew up in Houston. Went to school in Houston, graduated from University of Houston, and worked at a CPA firm right out of college. I went to a college for accounting. Worked at a CPA firm called Gaynor Donnelly and DeRoche. That's kind of split into a million pieces now that the partners have retired and they sold and all that. But after I got my CPA, I went to go work for a firm called BDO at Gaynor Donnelly. We're doing kind of private client services, wealthy families with trusts and estates and the grandma's return and the business and all that. And then at BDO, I was kind of working on billion-dollar public companies, private equity-backed companies, doing tax provisions, tax returns for, huge stuff. And in 2014, left to go out on my own and had a couple of clients. One of my college roommates was buying a building and helped them structure it, set up the books, all that. And then picked up their work and picked up a few things and have spun up. Today, there's 10 of us and we have, a couple of hundred clients, and we're growing rapidly and trying to manage the growth.
Dude, that's awesome.
Yeah.
What would you say y'all do?
We work. Beyond that, I a couple of years ago got a CFP, and I'm a financial planner. And so we're looking to basically a fractional family office, fractional CFO. We want to go soup to nuts with people, work very deeply, working on their, obviously, tax planning, financial planning. We do some investment management. Typically, we don't custody. We just help people with their investments. And we do some bookkeeping work and then kind of consulting CFO one-off projects. But yeah, I want to have clients that I work at a deep level with on kind of a lot of what they do. So,
and is most of what you're doing, like your bigger clients, are those family businesses? Is it any?
It's generally GPs or business owners who, are underserved by the traditional brokerage model. And that, if they're older and they've accumulated a lot of wealth in their brokerage, still their business is traditionally their largest asset, or their GP share of their kind of real estate portfolio is their largest asset. It's very illiquid. It's very kind of highly concentrated. And they, the folks I work with need advice on that piece of their portfolio, and everything else kind of surrounds that to support that.
It's amazing how many families I've met throughout the years that have these gigantic private illiquid businesses that just print money.
Yep.
But then you kind of look around it and it's like, just because you know how to make money doesn't mean you know how to invest money, doesn't mean you know how to plan with it, doesn't mean you know how to give it to your family.
Sure.
And you see it over and over, like these huge businesses. And you're like, well, if you could grow that business, you can do all the rest of the stuff. And it's like they're crippled once they get outside of the business.
Yeah. And, also beginning with the end in mind of how are we going to build succession in this business, or when are we going to sell this business, or how are we going to pass it down to our kids? And then, what are we going to do with the money that accumulates? Are we going to invest it in the market or something else, or real estate, or are we going to put it back into the business? How, how big can it grow?
So I have like two kind of topics today.
Sure.
But as we're like starting to talk about this, I think we could do a pretty cool 20, 30 minutes on, I'm going to be a guy that has a big family business.
Yep.
And I'm getting into my 60s and 70s because we know we're entering that generation where there's going to be thousands of us.
Yep.
And I come to you and I say, let's just say I've got a $50 million company. It's all I've ever done. I've got 3 kids. They've got kids. And I've never done any planning. Mitchell, what are we going to do?
Yeah, and Twitter, frankly, has made me think a lot more about this. And obviously, we're thinking a lot about this, um, kind of at the old CPA firm at Sam Gainer's office. But obviously, it's so much easier to take a seed, or you may not have a seed, but you have a sproutling relative to kind of what it will be, and kind of push it over the fence, as opposed to taking an oak tree and trying to move an oak tree. I mean, it's impossible. So, yeah, that's the big question is, hey, you have this $50 million generational wealth transfer tax problem today. You're 60, 70, and the climate is changing into what's going to be a more and more unfavorable thing, and your money's making money on your money, and it's not going to get better, and it has to be addressed. I mean, that's when you get in. I kind of think of it in layers of the initial thing is like, hey, I'm got this side hustle. Like,
yeah,
let's start with hygiene and just really like compartmentalizing your accounting into its own thing, setting up an LLC, doing an S corp, doing all that stuff. Then the second thing is like, oh, I have a business now. I'm quitting my job. I'm hiring people. Then you get into that layer of trying to manage and grow your business. And then once you've gotten to this level of, hey, I'm 50 and I'm wealthy, it's better to kind of obviously rewind and take care of all that when you could have. But yeah, then you get into, you're not thinking about a bank account. You're not thinking about a business. You've zoomed out. And now you're thinking about 4 generations of wealth transfer. Moses talks the most about this. And we were talking about it the other day, about just kind of how do you begin with the end in mind and set up trusts and get assets out of your name that are still under your control, and build systems and design a family organization where you can pass down wealth and have it do what you want to do, and have your children and grandchildren grow up the way you want to grow up, or you want them to grow up. How do you design your life? And obviously people do what they're going to do, and it never.
Well, it's kind of weird also, because it's like, as soon as you actually, like you kind of talked about, it's like you kind of go through your 30s and you're making it, and you're like in your 40s, you're kind of arriving.
Mm-hmm.
And then it's like, as soon as you have an issue to deal with, or as soon as you have enough money to have an issue, it's like, rather than like enjoy it it's like, now we got to start, you have a new issue. It's like, oh shit, we just spent 20 years getting it. Now we got to figure out how to give it.
Yeah. I just accumulated a bunch of wealth and paid tax for the whole ride. And now I have this new tax problem of like, if I don't scramble and get it out of my own name, then it's going to all be taxed again, massively. And beyond even tax, just this kid can use the money and grow the money. This kid, if I give them the money, they're going to die.
Yep.
I mean, that's a reality, and a big issue of.
Do you have to have that conversation with, like, do you ever play psychologist?
That's all you do.
Yeah.
Or, I mean, that's all everyone does at a certain point, is you go, hey, what are your goals? What do you want to do? What is going to happen once you play this all the way through?
So I'm 60. I've got a $50 million business. Is your first question to me, do you have a kid that's going to take over it? If you don't, do you still want to own it and live off of it, or are you going to sell it?
Yeah. Are we growing this to sell, or are we growing this to transfer? And who's the operator? Who are the other pieces? How are we going to create an equitable, fair situation, if that's what you want? Not everyone wants a fair situation, frankly.
What is a not fair situation?
Fair being every kid's going to get an equal amount. I mean, some people go, hey, that kid worked and helped me grow the business, and they get to participate in the upside. That other kid works in the business, but isn't contributing. I mean,
okay, so you hear that.
Yeah.
Does your radar immediately go up like, this is going to be nasty?
Well, it just immediately goes, well, it's just so important to understand it's not my business. It's not my judgment.
Yeah.
It's not my kids. So I don't go and sit at your Thanksgiving dinner table.
Right.
So ultimately, my job is to facilitate, to try to get to what the client wants, and people have different levels of self-awareness. Back to the psychological thing where you're going deep into like, well, what do you actually want? What is your plan? Because it's not my plan.
But don't they mostly not know what they want? Like they think they do, but they don't.
Yeah, probably.
Yeah.
I was talking to another, in the same way that I don't want to take all people's assets and do whatever I want to do with their assets. I think people who go and build $60 million companies are smart people. Like you said, they are specialized and they have focus, but I think you're free to go do whatever you want with the money you made, right? It's your money.
For sure.
And so it's my job to help you kind of dig in. And I'm not a psychologist, but it is my job to help you kind of really just ask the questions about like, hey, so you're going to give this kid that, and you're going to give that kid that, and you're going to give this other kid that. Is that what you want? Is that fair?
So let's just assume I came to you and I just said, I'm not going to sell the business. I'm hiring a COO. I want the business to keep going.
Sure.
I'm parachuting out. I'm going to my beach house that I've deserved to be on.
Yep.
But I have 3 kids. What's your first question to me?
I go, what do you want to... so if you monetize this business or the value of this business, what do you want to do with the rest of your life? What do you want to spend your money on? How much do you want to leave to your kids? Do you want your name on a building? Where do you want to give your money? What do you want to happen with all this when you're dead?
Yeah.
And then you kind of really design, what do you want your grandkids to have? What do you want your grandkids to have? What do you want them? What do you want your family story to be? What do you want your community story to be? What do you want your life story to be? And then you work backwards to try to make all that happen.
And let's just on the topic,
and it's way different with like a 30-year-old than a 60.
For sure.
You know what I mean? Because a 30-year-old's going. I look at you and I'm like, hey, just let's do a couple of. My thing to you would be, you have this leveraged equity general partner interest in this company. Let's think about what we can do with your general partner interest to get it into some facility that when it's $60 million, you put it in at $10 million and, it gets to grow and grow and grow. And if it's not $10 million yet, call me when it is. What's the velocity of that? I mean, you talk to the venture equity people where you go, man, what if you have the next, the seed round of the next Airbnb, and what are you going to do with that when it kind of overnight, turns into something that becomes quickly unmanageable? And I've seen people make $100 million and be able to manage it in their life through trusts and through setups and notes and all kinds of ways. But I would say you have the ramp up and you want to, as soon as you go, okay, this is happening, this is going this way, this is going to multiply this way. If you can begin with the end in mind. But I mean, you have young kids, you don't know which one of your kids is going to have this and that, and you don't want to. It's all about in that kind of like generational wealth, maintaining control while getting it out of your name. And
is there like a certain dollar figure that no matter how old you are, once your net worth is X, you should start?
I mean, the big ones. Today the lifetime exemption is $22 million for a married couple. So when you go, hey, I'm there, or I'm past there, or I'm going to be past there in 4 years, and it's inevitable, that you start thinking about that, and you start thinking about kind of building that container of how to how to structure,
Yeah.
the generational piece of it. And then, and then that goes back to, you know, when you make $50,000, it's time to go set up an LLC.
Yeah.
It's kind of built on this continuum of like every time you hit a certain level, you go start to pay more and do more, and you don't want to have the same tax plan at 50 million that you did at 50,000, I think.
And one more kind of question on the giving part, because I know that's a big deal for a lot of people. So you kind of know my story. I'm 70 years old, relatively healthy. I'll be around for a while. I've set up the kids. And you kind of said like your giving plan, is it upon you to kind of help him think like, okay, here's how much cash you're generating, here are tax rates, da 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 da. You should give $500,000 a year? Or how do you kind of prescribe what the giving strategy should be?
I mean, I have clients who give millions of dollars away, and I have clients who kind of don't give at all, and that's their prerogative, right? Like ultimately, some people are like, no, charity. Yeah. I have a client, they've given into this, they've basically built a private foundation in their family, and they have a board which consists of their family, which is like a wonderful thing to do. They seeded it with a public company stock that's just gone bananas over, the great grandfather was the general counsel of KBR, like just call it that, what I mean? And that stock seed is now worth, and he set it up, and it's gone from generation to generation. And you watch that and you go, oh, wow, this is amazing. You get to have the kids on the board. You get to have the grandkids think about giving. Obviously, not everyone's in that position in their life. I mean, some people are making enough to take care of their family, which is great. But, and some people go, hey, charity's a waste of money. I'll give it to them. They'll just waste it. And I want to go dig wells in Africa, or whatever they want to, whatever you want to do, you should do. That's what my thing in that sense is, do you want your name on a building? Do you want to give it overseas? What do you want to do? Can you afford to do it? And how's it going to ripple through the rest of your planning? I mean, it becomes like budgeting.
Yeah. But if I've said like, I want to give, I don't really want to go to Africa and dig wells, but I do want to give. Does your firm kind of give me like, here's your allocation every year that you should think about giving?
And you have, you can do charitable giving trusts where you can give in line with an exit event. Or, I mean, Fidelity has a program where you can do a deferred giving thing where you basically, you sell your company for $20 million. You don't want to give $500 a year. You want to give $6 million this year. That's going to fund your giving for your lifetime.
Yep.
And so there's a lot of planning around giving. So that's a big thing that I talk to people about, especially when they're older. What do you want to give? How do you want to give? Who do you want to give it to? And I have a guy right now who's giving to the university that he worked at. And the big thing is give your RMDs. He's sending his RMDs straight to
what's an RMD?
Required minimum distribution when you're 70 and a half, and all those IRAs you saved up, they start making you take it out. Yep. You can give it straight to a charitable organization without having to recognize the income and then take the deduction. It just goes straight out the door.
Interesting.
So that's something. Yeah. So you go back to like getting a certified financial planner certificate, and you're covering asset protection, taxes, investments, estate planning. You're covering all budgeting and all of these big buckets. And that's really kind of what I wanted to do with my clients is serve as just kind of the fractional family office.
I love how you said it that way. I've not. Yeah. Are there a lot of those, or are you kind of unique to this like perspective?
It's a more and more kind of. It's a trend that's picking up in the sense of fee only planner kind of the like one of the bigger ones that's doing a really good job is Creative Planning.
Okay.
Have you heard of them?
No.
Or like Peter Maluk runs that, and they are investment advisors. They have in-house lawyers, in-house CPAs, and they're growing pretty big while they're doing all that, and they're growing in offices in a bunch of cities. But yeah, I mean, the industry is trending towards fee only, towards fiduciary advice, toward kind of serving their clients not by selling products, but by trying to provide solutions. And obviously, I'm very indexed in tax and tax planning, but that's a great place to be indexed because it's very expensive. Frankly, I mean, your taxes when you have put together an assembled wealth like that can be very, very costly.
Yeah.
But then, and where I would be less indexed in investments, I say index, like I'd go, hey, why don't you go index? And if you want to own some Bitcoin, own some Bitcoin. And if you want to own a bunch of real estate, own some real estate. And let's, again,
are they calling you like every time they have like a spare, call it $1 million, and being like, hey, Mitchell, buddy down the street just sent me a real estate deal.
Yeah.
Should I do it? Do they need like your, not permission, but do they kind of run that by you? Or
ideally, I mean, I'm not the money police, but that's where I try to build engagements through like a monthly retainer structure. And I always tell people, like, I want you to call me. I had a guy a few years ago who called me, in April, and he goes, hey, we need to do my taxes. I sold my business. And I was like, what, you sold your business? And he's like, yeah. And I was like, am I your accountant? Like, why would you sell your business and not call your accountant? Like, okay. And it was all, it just was not the way I would have advised him to do it. It was fine. It was done. But, that's where I always tell people, I'm like, I do not want to have you call me in April and tell me to file your extension and then drop off a bunch of crap in middle of July and me flip it back to you in August and we file. And then I never hear from you again until April. That's kind of not, that's just not the advice I want to give.
Yeah.
So that's where I try. I try to encourage people, and I try to build a client base and a structure where I have availability to be there to answer those questions. And even more and more, I'm trying to build systems where we take clients in at a higher level and we do more for them, so that the more we do, it kind of we have a closer view into the data.
Yeah. Do you have software or something that kind of, is it proprietary or something you subscribe to?
That's what we're actually building right now, a proprietary software that's like a dashboard that takes your personal balance sheet and your personal investments and your business balance sheet and like our little secret sauce of a tax projection and puts it all into one dashboard. And we're early into that. Very early. But that's my vision, is that if we could just get all that onto one screen and update it on a quarterly basis, we'd be having such a different conversation than if we talked every 15 months or 12 months or so.
All right, we're going to pivot just a little and kind of get into like just one-off questions on certain things. Our favorite friend, Nick, asked...
Nick who?
Nick Huber.
Oh.
Nick who?
Hi, Nick.
Mike Jones. Who do most CPAs act like? Why do most CPAs act like they work for the IRS instead of working for their client?
Yeah. It's a tough job. I'll tell you that. And I mean, and it's been a tough few years, and it's been, deadlines getting extended and rules changing and PPP and this and that. And it's not, I've tried to, especially, first of all, as an aside, Nick is the guy who like brought me into Twitter in October and shined a light on me and like has really given me a lot, and I'm grateful. So thank you, Nick. and it's enabled me to, I started getting people reaching out to me and people calling me, and frankly, I'm like
overwhelmed.
Oversubscribed. Yeah. I'm trying to build out a system right now to catch and serve and deliver the promise that I'm giving to people, and trying to, do good work for all these people. And, but yeah, it's a hard job, and it's if you don't intentionally build your business and think about it and intentionally charge the fees required to do the work that you need to do, you just get drowned, and there. So that's the that's the nicest thing you could. That's the most charitable kind of description that I would answer that question. And then just
because at the end of the day, is it your problem or is it the client's problem if a return is like, oh, we're going to audit this? So when I think of a CPA kind of being on the IRS side, it's not more that they're on the IRS side. It's that they're protecting their client from the IRS, and they know what the IRS could come after them for.
Yeah, hopefully, ultimately, ultimately, yeah, it's my job, and I'm aggressive in the sense that I want people to use the tax code to their advantage and take deductions that rightfully belong to them, and take loopholes or all of these kind of strategies that allow you to pay the tax that you rightfully owe if you understand the rules. I mean, that's how I would say it. A lot of people just, because a lot of people just want to either get it done quick or just hate their clients, or, whatever it is, or just don't understand. Ultimately, your tax is a business decision, and you take risk in your business, and you measure risk all day long. And why would you not do that with your taxes? And in the sense of, hey, how much is it worth spending money to develop plans and develop procedures and capture income, capture data to be able to file the best tax return that I can possibly file on my behalf to save the most money I can? And some CPAs just don't see it that way.
Yeah.
So I've seen CPAs who hate their clients because their clients make more money than they do, or I mean, and if that's your CPA, that should, you should probably find a new CPA.
That's kind of an interesting thought. You get to sit there and watch, like, not. The question isn't about envy, but you get to sit there and watch people with, I would assume, hundreds of millions of dollars.
Yeah.
What is it like to be involved in that so intimately? That's a unique position that you're put in. Do you ever wake up days like, God damn, this motivates me?
Yeah, it's very. Sometimes I go, I'm in the wrong business, because because this guy, because people will call you and you'll go, oh my gosh, that's your business. Like, oh, I need to do that. I need, because if I spend all my time doing that, it'd be more lucrative at least. But it's really exciting in the sense of, I mean, I was 22, 23, 24, and you sit down with some guy who is making $5 million a year, and you just go, I make $50,000 a year, and you make $5 million a year. Like, what do you? And I mean, I have an ego, and I think I'm smart, and I go, why are you so smart that you get to do this, and I don't? And the answer is, I don't know.
Yeah.
you got, that's my problem.
For sure.
I got to figure that one out. So
if you're selling your business, is there any kind of best practices that you should do, like a year, 2, 3 out, to kind of get ready to sell?
There's a lot of people on Twitter who are very qualified to talk about. I've learned a lot about this. I'll give a shout out and a plug to Girdley and Mills and Bill on Acquisitions Anonymous. I mean, they go walk through deals and just talk about deals. And, ultimately, it's a marketing exercise the same way that anything else is, where the best thing you can do is have clarity in how you show your numbers, because people are going to judge your business based on your history. They're going to give you some percentage of revenue or some percentage of EBITDA or some percentage of whatever the seller takes home, and your job is to show them what you're taking home, what your revenue is, what your EBITDA is, and show them in the most concrete way. People try to save money on taxes and give every one of their grandkids the gas card and buy cars for everyone in the family, and and they're trying to sell their business in 3 years, and then they have to go, well, it shows I made $1 million, but I really made $3 million because my grandkids, because of all these ad backs. And I mean, $1 could be $7 or $10 or $19. So, you're trying to save 30 cents on taxes, or 40 cents or 50 cents or 60 cents on taxes, and you just cost yourself $19. So that's the biggest. Most answers around this are like, build a system and begin with the end in mind of like, if I take that deduction today, what's the net present value of that deduction? Well, 40 cents today could cost me $19 in 3 years.
But do most buyers then go, like, you show proof that the kids were on the gas cards, they'll let you add it back and give you value for it?
It depends. Or you've done enough deals to know that. But yeah, you could do like a loan out corp. That's one thing I tell people to do, is just go. But then
what's a loan out corp?
So like, you set up a separate management company where
you can't throw big words out like that and me not ask you what they are.
Thank you. No.
What's a loan out corp?
You could go set up a separate entity that employed the owners of the company, or was a management company that paid a management fee or a royalty or some kind of ongoing revenue to this company, that then is the cookie jar for the owners that they can go spend all their money. But then it becomes this IRS honeypot where it's just like, some top line revenue full of a bunch of bullcrap expenses. And then you don't really want to like shine a light or compartmentalize all the most gray area expenses of an entire business into one company. But, again, it goes back to risk reward of, so that thing gets audited, all the expenses get added back, you pay the tax, you pay the IRS, but you made your sale transaction very simple, and you earned a lot more.
So basically, you have a business, you let it operate as such. One of its vendors that it pays is this loan out corp.
And then you go onto your ad back and you just go, hey, that $10,000
that
a month
I spend to the loan out corp,
that will go away day one. Here's the contract. You can rip it up.
Interesting.
But it's all about compartmentalization and about clean books and clean records, and having some kind of system where you can show that all people are buying is essentially
cash
flow. And so if you can show them the clearest kind of picture of what their cash flow is going to be when they take over that company, then they're going to believe you. The more muddy it is, the bigger of a discount you're going to get, because the more uncertainty of cash flow.
Do they need to get? Unless it's just an awesome business and they go, oh, this guy's incompetent and I'm going to triple it, and then you may get more. Yeah.
So again, it's deal by deal.
Deal by deal.
Everything in taxes, it depends. Or everything in businesses, it depends.
Do they need audited financials a couple years in advance? Is that like everybody always says, like, if you're going to sell, start getting your financials audited the 2 or 3 years before you go to sell. Is that as big of a deal?
Yeah, certainly, it becomes a big deal
the bigger
at
the company
an institutional level. Yeah, if you're going to go sell your deal to BlackRock, you probably need audited financials. If you're going to sell your deal to
sweaty startup,
how many audited financials? If Nick saw audited financials on a storage deal, he would run away. So it depends who your buyer is.
Yeah, he wants paper receipts.
He wants a Rolodex and a fax machine, right?
What is QSBS?
So that's qualified small business stock. Section 1202. It's basically you organize your company as a C Corp, and the founding issued shares, if you hold them for a certain period of time, you get to sell them and you get to get a large tax exclusion on the sale of those shares. So basically, most businesses would either be started as a partnership if you have partners, or if it's just, my business is an S corp. I have a accounting, financial advisory kind of consulting business that's a pretty simple business. I'm the owner of it. The proceeds of the business go to me. Well, people who raise money and generally think that they're going to sell the business for much more than they raise, and it's not an asset heavy business. There's not going to be a bunch of depreciation. There's not going to be a bunch of tax write-offs along the way. Will organize their business as a C corporation or as a LLC and elect to be taxed as a C corporation. And it gives people the opportunity, this kind of provision in the tax code, to go sell their business that they held for, I think it's 5 years. You basically get to exclude the gains from the sale, and you just get.
So like a real estate company would never do that because they're so asset heavy.
You would do it for for your new media company.
Yeah.
I mean, that's it. So it's really software or a product company. Something that if you were doing an Amazon FBA business and you were just going to buy and sell inventory, you could do that. You just have to hold it long enough, and you have to kind of. That's one of those where it's like, if you're really in that, you got to go get professional advice, because you got to do it right, and you got to stay very, very rigorous and following the procedures and meeting the timelines and meeting the
because
deadlines.
Of what you said about the beginning and raising that capital kind of early on. Is it kind of you can't really, like, if you're a 10-year-old business, kind of transfer into a C corp, like you're kind of too far down the road at that point?
You could, so long as you're willing to cut. If you set up a new C corp, push your stuff into it, and then meet the holding requirements and grow the business. Yeah.
Okay. So, fair enough.
Certainly.
How does a SPAC work?
I may be the wrong guy to ask, but it's a special purpose acquisition corporation. It's a company that's, to my understanding, essentially raising a blank check or raising money to go acquire either a particular company or companies inside of a certain industry or companies inside of a certain product type. It's almost like a fund or like a mutual fund, but it's a public corporation.
Besides the ability, though, to go take a private company public, is there any tax advantages or anything that kind of gets into your level where it's strategic to go through a SPAC vehicle?
I mean, I think the big thing is, and this is like not my expertise, but so I'll just pontificate. But I think the big thing is you get to utilize. You have a very liquid market. You get to raise some capital. You want to talk about kind of like leveraged equity. There can be major benefits to the founders and owners and the people who are organizing it. And it's an interesting way to raise a bunch of money to go buy companies that are illiquid. I mean, think about it. A lot of public companies trade at 25, 30x, and a lot of private companies trade at 4x. So if you can, grow and build and institutionalize and scale private companies and then bring them into the public markets, there's a killing to be made.
Yep. Do you have a story or two that comes to mind? What are some egregious and outlandish ways you've seen people avoid taxes? Is there a fun story or anything that comes to mind?
They were talking about the flamingo farm, right?
Yes.
No.
the ostrich in the backyard.
The ostrich in the backyard. Literally, I worked with a guy in one of my original jobs who had an avocado tree in his backyard and called it a farm. And I guess knew he wouldn't get caught and didn't care, and just thought it was funny.
Yeah.
So I mean, you see some crazy stuff.
Yeah.
You see it on the client kind of driving, and then you see it on the accountant side of, there's accountants who take risks for their clients that their clients don't understand, which is mind-boggling to me. Or there's accountants who are just incompetent, who are, you get it and you get the return from. I had a client, I got a return that was I got a client in, and I was like, have your old CPA do this year. We're waiting a year. We don't have time to do this. And then I looked at the return, and it was literally like out of balance. And I was like, okay, we need to do this. I think we need to like fix this. You can't work with this guy anymore.
Yeah.
But
well, then maybe not even outlandish, but is there like a totally bulletproof way that most people don't think about saving taxes for the average guy?
Yeah, I think the best thing to do, if you and your wife or spouse or if you're just kind of normal, have normal jobs, the best thing you can do is develop some side revenue stream, and take all of these expenses that already exist in your life, your cell phone bill that your company's not reimbursing, your car that you pay for, you're paying for all of those post-tax. You make $1, you pay 50 cents, and then you take that remaining 50 cents and pay your cell phone bill. Go develop some stream of income or some kind of management revenue or something, and be able to take that cell phone bill and bring it to pre-tax, because you need a cell phone bill to do most. You need a cell phone to do most jobs. So that's like the first thing I tell people, and then the bigger thing, then it becomes company structure, and do I have an S corp or do I have an LLC? And getting into, if you own your own company, how can you set up cash balance pension plans and all kinds of.
What's a cash balance pension plan?
It's like they have defined contribution, which would be like a 401k or an IRA, and then they have defined benefit, which is what our grandparents had, these pension plans where you fund it with enough money that you're going to get a $6,200 a month check when you're 74.
Yeah.
Well, if you own your own business, whether you have employees or don't have employees, you can set up a pension plan, and you can, in order to, if you're 41 and you want to have $6,300 a month when you're 65, it's going to take a lot of money to generate that stream of revenue in perpetuity. And so you can put like $400,000 into it to try to
get there.
And if you have no employees and you're just on your own, you're the beneficiary of that entire thing.
Yeah.
Don't do this in real estate, by the way, because I don't know any. Do this if you're like an endodontist who just makes $3 million a year and doesn't know what to do with your cash, and that becomes, nothing's one size fits all. So going back to kind of what are the bulletproof ways, it's just kind of going through the checklist and going through the planning and going, hey, what fit? Am I taking every deduction that I could deduct and deducting it?
Yeah.
Am I structured properly? Am I saving the way I want for retirement to the extent that the code allows me? Is my accumulated earnings that I paid tax on being invested in the most efficient way? And talk about cost segregation and bonus depreciation and passive losses versus active real estate. Is there some other way that you can go take your money and generate cash flow while using leverage and getting huge deductions along the way while you're in your kind of high earning periods? That's a big one too.
Cost seg and bonus depreciation.
Yep.
You hit the magic words on the head.
Of course.
What are they? And then let's break it out to like multifamily versus commercial, like where the benefits lie in
Sure.
asset classes.
The benefits lie for generally people who either have passive income in another area of their life. And don't confuse portfolio income with passive income. Dividends and capital gains and stock sales and interest is portfolio income. Passive income is income you earn from passive investments. So as people accumulate wealth, their passive income becomes inevitable. But when you're making your first investment into something, it generally, you don't have lots of passive income. So, really, this is the most useful for people who are real estate pros or have passive income in their life. But yeah, so the model is you take your equity, you leverage your equity with debt. So you take $500,000 and you buy a $2 million property, right? And you go buy an apartment building, and you can take. There's a portion of that apartment building which is land, and there's a portion of that apartment building which is land improvement, and then there's a portion of that which is the actual building.
Yep.
And basically, you can take all of the property and break it into its source components, and all of the source components have different asset kind of life classes or like asset lives. So there's 5-year property, 7-year property, 15-year property, 27, 39 on multifamily versus commercial. And you can take all the 5-year, 7-year, and 15-year property and bonus depreciate it. You can take it all in the first year that you place it into service and just deduct it, write it off. So you take a guy like Wes Mabry, and
he actually is doing one for us right now.
Yeah. So you take him, and he'll come in, and he's an engineer who will look at your building and take pictures of your building and break it into its component pieces, and then give you a report of what did you buy that was 15-year property, which is the site improvements. What did you buy that was 5-year property, which is microwaves, dishwashers, stoves. What did you buy that was 39-year property, which is the walls and the foundation and the roof and the And so you break it up into those component pieces, and what it results in is you find that about 30 or 20, 30, 40, 15% of this thing is able to be written off in the first year, which, in this $2 million example at 25%, you basically took your 500,000, put it into the deal and levered it up. And then you get to take that 500,000 and deduct it in the first year, because your 25% equity became your 25% of what was able to be cost segged in the first year. So,
and if you're in real estate private equity, so you have LPs and GPs, and you do it, and let's just say you have 15 partners in a deal, that depreciation flows through to the LPs unless otherwise negotiated in the operating agreement ahead of time.
Yeah, and so there's different ways to, based on who can have the most benefit from the depreciation. I mean, if you're dealing with an institution or somebody who doesn't pay tax, or somebody who is a passive real estate investor, they're going to realize no benefit of that immediate hit of depreciation. So part of the terms on the outset of the deal could be that you write a more complex agreement that allows the general partner or certain partners to pull in a lot of that bonus depreciation for themselves and derive the benefit during the life of the deal. I mean, and that goes to like any partnership can be structured any way where I could give Chris all the losses, I take all the profits, and Johnny takes all the cash. and then the tax credit goes to Dan.
Yeah.
So I mean, that's how tax credit deals and where there's certain deals where you go improve a building and the city or the state or the government gives you some kind of historic tax credit or some kind of charitable contribution or some kind of a special tax preference. And then they'll actually take those credits and syndicate them, meaning you can go take those credits out of the partnership and sell them to other people who just want the credit or just need the credit. I mean, that's a way to take $20 and buy $100 of charitable contribution, and so it goes all the way into the way esoteric. But
so on the $2 million example, you put down 500 grand, you get a loan for $1.5 million, you bonus depreciate. Bonus depreciate and cost seg are basically the same thing.
Well, the
cost seg is the act of getting to a bonus depreciation number.
The cost segregation is kind of this report or this engineering exercise in order to break a building and a land site into its component parts so that you can bonus depreciate the asset classes available so that you can get a big old deduction.
And you get the $500,000 deduction. So your first $500,000 in income that year is basically now tax-free.
Yes.
And so if you're somebody that's buying lots of properties and you're just getting $500,000 now,
and you're using leverage.
So 500 because and you're getting interest deduction, blah blah blah. So you do 5 deals that year. You might have $2.5 million of write-offs, paper write-offs, not actual losses. Now, when you go to sell it, it all gets captured back, correct?
Yes. So it's
you meet your maker at some point.
Newton's law of tax. Yeah, what goes up must come down. And so when you basically have destroyed your capital account, where your capital account was $500,000 because that was your equity to go buy the thing. You still have capital because of the either recourse debt or qualified non-recourse debt. You're not going to go into kind of a negative basis, but you will have recapture when you go sell the property. But if you hold the property for like you cost seg it when you buy it, you'll also cost seg it when you sell it. So you will do kind of a sale price allocation where you go, hey man, that refrigerator that was $1,000 and 5-year property, well, it's been 10 years and I don't even have that refrigerator anymore. Or that refrigerator is worth $100. And so, or the land has grown and grown and grown in value where, at the outset of this deal, we applied $500,000 to the land value. It's now worth 1.5. And, and we sold the property for 2.5. So the recapture available would be $1 million and not $2 million. And then these short-lived assets deteriorate in value very, very quickly. So the recapture shouldn't sting that bad. And the recapture is 25%. And,
it's 25% of what?
It's a 25% tax rate.
Okay, so do that quick math. So you got the $500,000 write down, and then let's just say 5 years later you sell it at $2 million, just to make it simple. What do you owe if you sell it for $2 million?
You're going to owe 25% on that. Let's just say everything there was no change in value.
Yeah.
But that's not even fair to say. So the 500 that you wrote down is now worth 250 because all the refrigerators are worth half. On a asset by asset level, everything that it has decreased in value by half, and so you're going to pay 25% on the 250, and then you're going to pay capital gains on the rest of the stack.
Got it. Got it.
So it's a better deal. It's not just you're just going to pay it back at the end of it's worth doing, especially depending on the deal size,
Somebody asked, parking areas, concrete on commercial property can add a large amount of bonus depreciation, detailed through a cost seg. What other pieces of real property are often overlooked for bonus depreciation?
Yeah, and that goes to that like kind of site value. One cool thing I've seen is like people who are redeveloping, where you can buy something and attribute the value of the stuff that you're about to just tear apart and rip out. And the day you rip it out, you've impaired that property, and you can write that to zero. So if you're going to buy a warehouse and just rip it down to the frame, there was some value in all the kind of stuff that was in that warehouse before you tore it all out and threw it in a dumpster.
Yeah.
That's a big write-off opportunity. And then you go and redevelop it, and then you bonus your redevelopment. So there's ways to come in and kind of creatively, I would say, it depends, and hire an expert. I mean, these are things where you're dealing with other people's money, and you're, going in and trying to do best by your LPs. Don't give your LPs tax advice. Don't DIY this one.
Yeah.
Go call our buddy Wes and just do it the right way.
Most real estate guys, I'm not saying like you learn the tax code along the way, but the truth is we're not tax experts.
Sure.
And then, like, as we talk about these things, I just think of over 16 years of doing projects. There's just so many things I never did.
Yeah.
I've just missed all this. It is the best practice, especially for someone that's doing this for a living.
Sure.
Like, if I were to buy a deal and you were my CPA, you were my guy, is the best practice just to call you after every deal and go, here's what we bought, and then just kind of get the game plan of like, here's what you should think about doing? Or who do I call?
Yeah, I mean,
Assuming you don't have like a CFO in-house that's just a wizard at all this stuff.
Yeah, find a CPA who picks up your calls and who adds value every time you call them, and then call them as much as they'll, as much as you can.
Yeah.
And then, pay them for the value, and life's good. I mean, that really is, you'll do that for the first 7 deals, and then every time you're gonna kind of like catch something, or there's gonna be a new layer, or I'm learning while you're learning, so we'll come on to stuff together, and but that's how you build that system. And it's really good to find a CPA who can be that kind of trusted advisor, and who you can really work with side by side in that kind of way. Because, I mean, I have several clients who, they essentially call me. They're not doing 50 deals a year. They're doing 3 or 4 deals a year, and they're just calling me every time they do a deal. And we're always doing something, So.
All right, 3 more questions.
Sure.
How to most efficiently structure a holding company with both operating and real estate investments?
I sort of talked about it earlier. I mean, that's where you have the opco, and you have each of the kind of sub entities, and every entity probably has a different capital stack and a different debt stack, and so you basically want different people do it different ways. Some people set up a separate general partner for each project. Some people have one general partner that does 10 projects, and then some people have the general partner is the management entity. Some people have a separate management entity. As you scale, you start adding entities to try to add asset protection along the way. I mean, really, but it's just a matter of when you're doing your first deal, it doesn't make sense to have 12 entities. It just kind of, and you see that and you go, man, if you're going to do 100 deals in the next 3 years, do it. If you're going to do 3 deals a year, it's like having a pet, or you're just kind of babysitting all these entities. So again, the answer is it depends, but you always, as the owner, want some kind of entity that can capture some kind of fee income, where you can take the expenses that exist in your life that are bona fide business expenses. It's not your kids' haircuts and your groceries. It's stuff that you do that has a you know, business application, but you don't want to be accountable to your partners or your investors on. And so structure your life where there's some stream of revenue that allows you to go have fun on your own and spend pre-tax dollars on the stuff that, that you get to do as a business owner.
Yeah.
That's my big piece of advice around that.
What, and we talked about it earlier, and maybe there's just a quick answer. Maybe it depends. How to best structure family businesses that are going to transition from one generation to the other so that it actually is going to stay in the family. And
it depends.
Yeah.
But, you see, especially once there's wealth, that the parents generally own the voting stock and the kids own non-voting stock. And as the kids work more or get older or hit benchmarks or stay off drugs or whatever, they get more and more stock. Again, as the company becomes more and more valuable, it becomes more and more expensive to gift the stock to your kids. So it's always about, how can I retain control while pushing this down a generation? And that's hard to do because that's exactly what the code doesn't want. So you have to think of, like if you just said, hey, here's a family limited partnership and I own the first tranche of shares. Well, you asked for the short answer, but I'm giving you the long one.
That's good.
So I own the A class and my kids own the B class, and they have 99% of the equity and I have 1% of the equity, and I have all of the voting and I have all of the profit and loss. When I die and the IRS looks at that, they're going to go, well, where's all the cash flow going and where's all the control? What is the value of this 99%? Well, it's nothing. What's the value of the 1%? Well, it's everything. So you need to structure it in a way that, and some people just go, hey, man, I don't want my kids to have my company. And when I die, I'm dead and they can deal with it then. And like, that's fair, I guess, but it's suboptimal, but it's fair, So like, that's one side. And then the other side is, I'm just going to give my kids the whole thing today to save taxes. And they both have drawbacks. And where you want to do is creatively structure the middle ground to meet your goals, optimize your tax, and just pass through generational wealth in the best way you can do it. So it depends.
What is the coolest way that you've seen a family set rules for grandkids and kids to actually earn? Like, is there a cool story of it's like you have to go to college, you have to get an MBA, you have to go work for another company for 5 years? Like, is there anything that comes to mind that's like, this was a really interesting way to pass wealth while keeping, people intact and motivated? And
well, like I told you about that family who, has this public or private foundation and has the, and there's a bunch of wealth in that family. But I mean, that to me, I was like tearing up when I told you about it. I mean, it's just such a great way to, they run it almost like, I belong to a steering committee of a museum in Houston. And I mean, it's similar in that they have these tiers of, based on the family lineage, groups of people who meet in different ways and are empowered to make choices and get this kind of like wider and wider aperture of their family's wealth as they get older and of what their desire is to do with their family's wealth. I mean, that to me is just a really cool idea. I mean,
does everybody get to participate, or are you kind of selected based on how you're doing in life?
I don't I don't know. I should like interview them and figure out exactly what they're doing around that.
Send them up here. I'll interview them.
Yeah. I'll send them to the fort. But yeah, I mean, so I like the idea of like, there's a few people who tell stories on Twitter about having their kids work and having their kids kind of supporting their kids and developing some type of business that allows them to work and really make money. Kevin Camp 4 talks about his daughter doing tie-dye masks and shirts and stuff, and you're just like, man, if somebody when I was 14 taught me a way to make $50 an hour, that would have blown my mind.
Yeah.
You know what I mean? And for better or worse, but I mean, that is a really, really powerful thing to teach your kids how to make $50 an hour when you're 14. Yeah. Holy smokes.
That's awesome.
I mean, Nick talks a lot about that, about cutting lawns, and his dad got him a lawnmower and would drive him around in the truck. And I mean, like, what better thing can you really do for like a 13-year-old kid than teach them to work, and not work futilely, but make a lot of money working relative to anything they could do at the mall,
I love it.
Yeah.
All right. So, you kind of talked earlier, and a lot of it's from Twitter, but a lot of it's just, you've been doing this since 2014. You're obviously super knowledgeable on this, on these topics, that your client demand is outpacing your ability to give everybody the same amount of value.
Sure.
Like, how are you thinking about growing your business going forward? Is it just telling people no? Is it scaling? Like, where's your head at?
Yeah, that's something that I think about and kind of wrestle with. And I mean, I'll blow smoke for you, Chris. I admire you so much and kind of how you're growing a company. And I've said out loud over and over and over, I don't want to have 20 people working for me.
Yeah.
And the more I say it,
every time you say it, a new person joins
a new
the
person
company.
shows up, and it's building culture and learning how to manage. And obviously, I have ideas. I have ways I like to do things that it's really exciting that they're resonating with people. And yeah, how do I build that to scale? And so, I mean, I got on Twitter in October, man, and it's been life-changing, and it's really exciting. And I've met so many interesting people that like you, that we have people in common and people in orbit. And we're
Roy
the same.
Sweeney.
Roy Sweeney. Hi, Roy.
Hey, Roy.
Yeah, and I mean, so it's really been fun, but yeah, it's presented this challenge of like, how do we deal with the influx? I mean, I've taken 100 client meetings or potential new client meetings in the past 5 months or more, which, and I could.
What would Nick tell you to do?
Yeah, and raise your prices.
Raise your prices.
Yeah, and so I've done some of that, and I'm also following my spiritual advisor Nick Huber's path, in that I'm going to build out some type of informational product that even walks through these levels of like, at the outset, there's just people who I don't have the capacity to serve any longer. And I have ideas and I have helpful solutions about how they can set their life up. And I'm going to build some kind of course or product or something that just shows you soup to nuts. Hey, you have a $50,000 side hustle. This is what to do. And here's some tax saving strategies. And here's some kind of financial planning and financial systems that I've been using forever in terms of just kind of setting up my financial life. And I mean, like I had this experience. I posted a thread before the year end about QBI optimization, and someone just comments and says, "Hey, that saved me $50,000." And you're like, "Oh, wow." The more people I can tell about these cool ideas, the more people will be spurred to call their accountant and implement these ideas. And there's a tremendous ROI for someone like that to read a free tweet.
As a guy that's sitting on the sidelines just looking in, and let's be honest, accounting and certified financial at the outset, it's not the most exciting thing in the world.
Sure.
But what I would say is, one, you've found a way to make it cool. We live in a generation where people affiliate with their brands, and you have 15,000 followers on Twitter, which I want to get into a little bit of that in a second. And it's not just about the numbers and the vanity metrics, but a guy that's an accountant in Houston, Texas, now has 15,000 followers talking mainly about stuff that in prior generations nobody would have ever paid attention to. I think you have an enormous opportunity to be the voice of everything we talked about today for this generation that's coming up.
Yeah, I mean, it's really, again, I've kind of been scrambling to build out the infrastructure, to build out the systems to be able to handle the influx. And I don't know if I need if I just need to scale to meet the demand, or if I need an entirely new paradigm, or I think informational product is the only way that I can really scale my message without, I just can't be everybody's accountant. There's only so many hours in the day.
Even 100 client meetings, it's great, but that's 200 hours.
Yeah.
That's 2 weeks. That's let's see, 40 hours.
Well, you can do them in 30 minutes now on Zoom. It's exciting. But
that's 5 work weeks.
It's a lot. And, just even the Zoom thing is great and wonderful, but it's also, tiring. I've found that I'll do 3 or 4 Zoom meetings and I have to go lay down. So, no, it's really been, I shared a few weeks ago, Noah Kagan wrote this book about kind of a bunch of wild tax strategies. And I mean, Noah runs AppSumo, which is a software kind of sales engine. And he became so obsessed and annoyed with the product out there, and he has an accountant that he spent hours and hours building this informational product that is frankly pretty good, really good. And I mean, it's a huge problem. Is what I've had a lot of people reach out to me on Twitter, and I've had I didn't realize that just people aren't thinking and talking about these things the way I am and we are and small business Twitter is. And it's really exciting, frankly, that, people are like, hey, I talked to 3 or 4, I'm not trying to brag on myself, but people will say, I talked to 3 or 4 accounts and they just don't get it. And our buddy Kevin Camp 4 said, an accountant who gets it. And that's just what it is. And so, I'm excited to kind of share that message and share the kind of brass tacks about how you put your life together on your own.
And we've talked about Twitter on multiple episodes. We're talking about it. And, I think a lot of people might just be like, well, these are all of Chris's crazy friends that live in this little corner of the world. But what I would just say is, when we say it's changed our life, it's not this cheesy way of saying something. Is like, one, you and I would not be sitting here right now if it wasn't for Twitter.
No.
We've had some awesome conversations back and forth leading up to this. I've talked on our podcast about over 400 investors this year. In 2020, we signed up from people we met off Twitter.
You filled that fund yesterday or the day before in 90 minutes, and one a couple of weeks before that quickly. And I mean, you see the way. Yeah, I've had this fortunate kind of. First of all, I'll say it again, Nick has just did
he tell you you need to do this?
I'll tell you the story. So my story about it, you asked one time, how did y'all meet? So I met Nick. He was running the Sweaty Startup subreddit, and I've never been an active Redditor, but somehow I fell on it, and I was like, this guy's smart. I just need to talk to this guy, and sent him an email, and he said, be on my podcast. And I was like, no, man, I don't want to do that. I just said, can I just pay you for a consult? And I was his first like dollar of revenue out of that project, he later said. But and we talked for an hour, and he's just an expert operator, and that's not my kind of like highest area of expertise. And I'm asking him questions, just hiring, firing, scaling, growing. And he's, got all this feedback, and we'd gone back and forth and back and forth. And then one day he calls me and he goes, "Hey, we had these accounting problems." And so I became his accountant. And so like last August, I call him and I go, "Hey, Nick, there's more moving vans going out of New York than they can replace them with. You need to get up to New York and start doing like white glove concierge moving service, like you are positioned to do that." And he's like, "No, man, I'm on Twitter now."
Yeah.
What? He goes, "Yeah, I mean, I'm on Twitter. I have 7,000 followers. It's changed my life. I have more, these people are such high quality that there's so many capital sources. There's so many people having these high level conversations. It would blow your mind. You got to get on Twitter." And I'm like, "Okay, like I'll call you after tax season, I guess." And so then I kind of like pull him up, and I set up my account, and I get on the Fringe, and then I'm kind of going into his comments, and he like reposted one of my comments, and I had 1,000 followers immediately. And then he texts me and he goes, "You're not posting anything. You're making me look foolish. You need to post." And so I start post, and I want to do it good, and I want to say the right thing. And so I put this long post together, and I mean, it's helped me clarify my thoughts. It's helped me build an audience. It's helped me meet people. Like you and I have 20 common connections on LinkedIn of all these people we know. But yeah, I never would have met you. You never would have met me. And, we think alike. And
the interesting part, I don't know exactly how to say it, but when you meet somebody that you connect with on Twitter, it's almost like an immediate, like, we're boys.
Yeah.
Like it's not this slow buildup. It just kind of happens.
And you get to read so much of people's like inner, you get to read the way people think. And so then you get to have this conversation where you've already aligned, or you already know, hey, this person thinks like me in this way, doesn't think like me in that way, thinks this, does this, knows these people. And you get to immediately go in and go, "Hey, you and I don't think alike on this. Well, let's talk about it." Or, "Hey, you and I think a lot alike on this. Let's talk about that." Or whatever you want to talk about. It's really a odd concept that it just makes everybody a lot more accessible, which I turned away from for a long time. And then, it's been very rewarding the more and more that I talk about. So,
all right, let's just do some personal questions so that the people can get to know Mitchell a little bit better, and then we'll go have some barbecue.
Yeah.
Do you have a childhood experience that you remember vividly that kind of shaped the direction that your life took? And for example, I've asked that to somebody. My parents got a divorce. It changed my whole life. I'll never forget it. And then positive things. My dad introduced me to golf, and is there anything that, as you think about your childhood, it's like, had that not happened, I might not be here today?
Yeah.
And it doesn't even have to be an instance.
No.
It could be like a thing.
Like growing up, like playing. I didn't play football all 4 years through high school, but like playing football as a kid was huge for me. And just, being able to go out there and, practice and learn and build up my body and build up my like grit and do really, really hard things. And, I kind of went toward it and away from it and back to it. And football was pretty big for me as a kid. And when I was a kid, my parents got a divorce, and I didn't have like people supervising me, or I didn't have people telling me, "Hey, this is how you make $50 an hour." And so I kind of figured out my way through school and a lot of that, and having coaches and having people take an interest in me was very valuable.
Were you good?
A kid. No, I mean, I was fine.
Where'd you play? What position?
I was like 40 pounds heavier, and I played offensive line.
Nice.
So I was slow.
Nice.
Yeah. So no, but that just, to me, it wasn't about being good. I was never that good. It was hard. I just remember it was tough, and it was a grind, and you were on the team, and you just had to do it.
Yep.
So that was really valuable to me.
Is there something that you believe that a lot of people around you don't believe?
I believe that you can mostly do anything you want to do, which some people believe that and some people don't. But I've had the fortune and luck and wonder in life to like really achieve a lot of my goals. And it wasn't through somebody giving it to me. It was through just really grinding and spending the time and thinking about it. And I mean, so yeah, I believe that when you focus on things and really decide to do things and really commit to things, that you can do them.
I love it. I'm with you on that. What's the best advice you've ever been given?
Just to be careful about who you marry. That has shaped my life more than
So awesome.
Yeah, I don't know that Melanie will listen to this, but I won't tell her. I'll surprise her. But yeah, just like nothing has changed my life more than me and my wife were dating in college early. I knew my wife in high school. We've been together for forever, and it's been like,
she's your rock.
Yeah, best thing that's ever happened to me.
That's awesome, dude. And y'all have kids?
2 kids. Yeah,
that's so awesome.
Yeah, so 8-month-old and a almost 3-year-old.
Are you done?
I don't know.
We'll do part 2 when you make the announcement.
Yeah, exactly. I'll call in.
Do you have a book that you love?
Going back to that idea of like you can do anything. Think and Grow Rich is. Have you ever read that?
No.
You should read it. It's a odd book, but it's kind of like that Dale Carnegie, like How to Win Friends. It's written in 1930 by a guy who was looking at Andrew Carnegie and Rockefeller and all these kind of stalwarts of industry, and kind of followed them and talked about how they built their lives. I read a book called Choose Yourself too, but which these are 2 like really impactful books on me that are all just about mindset. But Choose Yourself, it kind of made me like decide to leave my job. It was a book, a guy named James Altucher wrote it, and it was just about how if you want what you want in life, you have to bet on yourself and go get it.
I love it, man. All right, one more. And then we're going to go get some barbecue.
Okay, good.
What's the best way for people to reach you?
Twitter. At Baldridge CPA, BALDRIDGE CPA. I have a mailing list that I swear I'm going to start mailing people all the time. And DM me or go to my website. But yeah, Twitter.
Cool. Thanks so much, man, for coming up to Fort Worth today.
Thank you for having me.
This has been awesome.
Yeah, it really has been fun. And I'll be excited to get barbecue after this and do it again sometime.
We will do a part 2.
I'll have you on my podcast.
I love it.
Yeah.
You're going to be the voice of the industry.
Yeah, that's what I'm told.
All right, buddy.
Thanks. All right. Thanks.